Hi, I'm Adrian Helfert with Westwood. I'm back with our second quarter update. The second quarter was very interesting compared to the first quarter in that risk markets performed reasonably well, but certainly not the wonderful risk markets that we had in the first quarter. Meanwhile, interest rates dropped significantly faster than they did in the first quarter. What does this mean? Well, maybe it means that the Fed has already provided as much stimulus as it can, and more stimulus is becoming less and less effective. That's one possibility. The second is that they've already communicated as much as they can and all that has been absorbed. Either way, what we're seeing is less and less effectiveness of the central bank's monetary policy being extraordinarily loose, helping markets. While equities finished the quarter up, economic growth and earnings forecasts didn't move in the same direction. U.S. growth was actually getting revised down during the same course of the quarter, and just looking at the U.S. 10-year Treasury yield, well, that's often used as a proxy for growth, and that was going down significantly. I don't think if the central bank would have been dropping rates or implying dropping rates that the equity markets would have responded the same way in the second quarter. And at the same time, we have major catalysts still in the mix. Top of mind is the trade war possibility with China. As of May 6th, when the president put on increased tariffs on Chinese goods, or implied increased tariffs on Chinese goods, well, we saw increased concern around CEOs lowering their business confidence, lowering their expectations for capital expenditure. Looking forward, I think a broad question in investors' minds is and should be, why are we not going to be in recession in the next 12 months? Well, there are two things that are key telling us that could happen. Number one, the shape of the interest rate curve. Just looking at the implied probability of that says that there's a 33% chance we're going to be in recession in the next 12 months. We have not had it that high since the 1960s without a forthcoming recession. The second point is, this economic cycle in July ticked over to the longest economic expansion we've seen since the Civil War. It's a long cycle. Now, the reasons why I don't think we're going in recession in the next 12 months are, number one, household leverage has remained reasonably low, and the shadow banking products of the past have not really materialized. Investor leverage is not as high. Number two, expansions don't simply die of old age. We've seen a reasonably slow and low growth cycle. Nominal GDP growth has not grown near as much as in prior expansions. Thus, we still have spare capacity. So slow and grow continues, and the central banks still feed that dynamic and will provide the insurance to the market to keep valuations supported. At the same time, the trade war is a concern, and we don't look for resolution by the end of the year. Thanks for your time, and we look forward to speaking with you soon.